The foundation for China's social security contributions has reached its limit and can no longer sustain further increases. Even major cities like Beijing and Shanghai have refrained from publishing their latest average wage figures. This signals a profound shift. The most polished facade of China's economy no longer has the confidence to maintain the illusion of prosperity. In years past, Shanghai would enthusiastically announce record-high average wages for workers as early as June or July, promptly followed by an increase in the social security contribution base. Beijing consistently followed suit, almost as if the entire nation was celebrating these figures. Yet in 2025, as the calendar turns to September 6, there's only silence. This silence speaks louder than any statistic, as the social security contribution base fundamentally reflects a city's annual average wage. Rising wages should naturally elevate the base, falling wages should lower it. In China, however, wages may stagnate or decline, but the data reported by the Statistics Bureau must never show a downward trend, an absurd contradiction. Provinces like Hebei and Fujian have already broken ranks, quietly lowering their 2025 contribution bases compared to 2024. Why? Because businesses are no longer profitable and residents are struggling with dwindling incomes. No amount of statistical embellishment can conceal the reality of economic decline. The question arises, are Beijing and Shanghai withholding data because wages have genuinely stagnated, or because the figures are too embarrassing to reveal? This places the Statistics Bureau in a dilemma. Should they report rising disposable incomes? No one would believe it. Should they admit a decline? That would be a political misstep. So, they opt for silence. This is no mere anecdote, it is the reality unfolding before us. Three truths emerge. First, prosperity built on manipulated statistics will inevitably be exposed. Second, China's economically advanced regions have fallen into the middle income trap. Third, its less developed regions face a high likelihood of returning to poverty. Reflecting on the past, experts in 2018 projected that, under any model, China's Social Security Fund would face complete depletion by 2035. At that time, younger generations, those born in the 1980s and 1990s, were already questioning whether they would ever receive their pensions. Today, the situation has worsened. 3 years of pandemic-related disruptions have led to a sharp decline in employment and a plummeting birth rate. The 2035 deadline may now arrive a decade earlier, with some warning that Social Security could face strain as early as 2028. Increasingly, investment advisors urge young people to plan for retirement independently, warning against relying on state pensions. The money contributed today, they argue, will not return to the payer. Why? China's Social Security operates on a pay-as-you-go system, where contributions made today are not saved for the contributor's future, but are immediately dispersed to current pensioners. More troubling, these funds may be redirected to regions like Northeast China or Inner Mongolia, where pension systems are collapsing under the weight of severe aging and economic decline. Contributions from Shanghai and Beijing are effectively being funneled to sustain these struggling areas. Thus, the hard-earned money paid in is not for your retirement but serves as an unacknowledged national tax. If these funds were transparently accounted for, people might accept the system more readily. However, since 2022, Shanghai has ceased publishing detailed Social Security data, offering only vague totals. Beijing follows a similar pattern. The fear is clear. If the public saw discrepancies between contributions, payouts, and surpluses, they would demand answers about where their money has gone, answers no one is prepared to provide. Compounding the absurdity, even as corporate profits decline and workers' wages stagnate or fall, Social Security contribution bases continue to rise annually. Businesses, particularly by year's end, face immense pressure, as new bases require retroactive payments from the year's start. In Shanghai, companies already financially strained must still meet these elevated contribution requirements. Hangzhou is no exception. Last year, the minimum contribution base rose from 4,462 yuan to 4,812 yuan. While this increase may seem modest, for countless small businesses, it represents a critical threshold between survival and collapse. As 2025 draws to a close, many business owners are left in trepidation, wondering what new burdens await. In essence, Social Security in China is not a retirement safeguard, but a de facto tax, a tax with no return. It is cloaked in a narrative of noble purpose, for the nation, for the people, for the greater good. Yet who accounts for the struggles of local residents, or the survival of businesses? The data itself is perplexing. Before 2019, the average wage statistic was based solely on non-private sector employees, those in state-owned enterprises and public institutions, excluding private companies entirely. This led to reported average wages often double what most workers actually earned, creating a false impression of prosperity. The reality? Most workers were simply not counted. When it became clear that private sector workers, a significant portion of the workforce, could not afford the inflated contribution bases, authorities promised a transition to a full-caliber average wage that included private companies. Logically, this should have lowered the average wage by expanding the denominator, yet in cities like Shanghai, Beijing, and Hangzhou, the contribution base inexplicably rose after the transition. Is this logical? From a political perspective, it is entirely so. Just as China's stock market is not permitted to fall, lest it reflect poorly on regulators like the former securities chief Yi Huiman, wage statistics must never decline. They represent China's last vestige of dignity. The system, not the contributors, emerges as the ultimate beneficiary. When even wage data requires embellishment, and social security funds rely on transfers from other provinces to survive, this is the state of modern China. Young people pay ever-increasing amounts while receiving diminishing returns. The scale of the social security shortfall is staggering, beyond comprehension. In 2024, the Ministry of Human Resources and Social Security reported national pension income at approximately 6.2 trillion yuan, with expenditures around 6 trillion yuan. On the surface, a surplus exists, but this includes fiscal subsidies, state capital transfers, and one-time fund allocations. Versus expenditure 6.0t, highlighting the narrow margin. Without these interventions, the actual surplus is precariously thin. The population trend exacerbates this crisis. According to the National Bureau of Statistics, China recorded only 7.2 million newborns in 2024, a decline of nearly 500,000 from 2023, marking the lowest birth rate since the nation's founding. Meanwhile, the population over 60 has surpassed 300 million, comprising over 21% of the total population. This means one young person is supporting at least two elderly individuals, a stark illustration of aging before prosperity. Despite claims of rising disposable incomes, the reality is grim. Manufacturing profits are shrinking, private businesses are failing, the platform economy is contracting, young people are scraping by as delivery drivers or rideshare operators, and white-collar workers face stagnant wages, layoffs, and pay cuts. In this environment, Social Security contributions from the young cannot cover the enormous pension payouts, leading to a national pooling system that redistributes resources from prosperous coastal regions to heavily aging areas like the Northeast and Northwest. The outcome is clear. Contributors grow poorer, recipients multiply, and the funding pool dwindles. Young people increasingly view Social Security as a black hole. You pay thousands each month, with employers contributing even more, only for those funds to be immediately dispersed to others' pensions. By the time you reach retirement age, the pool is likely empty, a harsh reality of the pay-as-you-go system. Worse still, if economic growth falters, unemployment rises, and the youth population shrinks, Social Security revenue plummets, yet pension payouts remain non-negotiable. The solution? Government intervention through increased taxes, borrowing, or money printing, ultimately drawing from the public's wallets to fill the gap. Some describe Social Security as an intergenerational contract. The young support the elderly, and future generations will support today's contributors. But with declining birth rates and a shrinking youth population, this contract is effectively void. Those born in the 1980s and 1990s may find themselves the most disadvantaged generation, paying into the system for decades only to receive little or nothing in return. Regarding pension investment returns, the potential exists for funds to grow through market investments. In practice, however, Social Security funds are heavily restricted, primarily directed toward government bonds or state-driven projects. Even when invested in stocks or bonds, The goal is often to stabilize markets rather than generate returns. During the 2015 stock market crash, pension funds were deployed to rescue the market, resulting in significant losses. Today, the annualized return on Social Security funds hovers around 4%, well below inflation. This creates a vicious cycle. Contributions increase, returns diminish, the shortfall widens, fiscal pressure mounts, and young people, seeing the futility, can only muster a wry acknowledgement that their payments benefit others, not themselves. The pension crisis is not new. A 2019 internal report from the Central Finance and Economic Commission identified the Social Security shortfall as a systemic risk, potentially more explosive than real estate or local government debt. Unlike those sectors, which can rely on land sales or debt rollovers, pensions are a rigid cash flow obligation. Any delay in payments could trigger widespread social unrest, making the pension shortfall the greatest threat to China's economic stability. What can ordinary people do? First, they must accept a harsh truth. The money paid into Social Security is unlikely to be returned, at least not in proportion to contributions. Financial advisors urge young people to plan for retirement independently, but with many struggling to afford basic living expenses, investing in commercial pension plans or long-term investments is often impossible, a source of profound despair. Social Security mandates contributions, yet those funds do not belong to the contributor. Saving independently is desirable but often unattainable. Young people are squeezed, the elderly are barely sustained, and the system demands ever more resources. This is not a system of mutual benefit but a zero-sum trap. The irony is stark. The world's factory of decades past now sees its youth surviving on gig work. The economic miracles of yesterday are replaced by stagnant wages and unpublished Social Security bases. The population dividend has become a pension burden, and the narrative of prosperity is sustained only by statistical manipulation. Prosperity may be crafted through numbers, but collapse is undeniably real, and it has already begun. Thanks for watching and joining us on this journey to unveil China's many layers. If you found this video insightful, please give it a thumbs up, share it with others, and hit that subscribe button to stay updated. See you in the next video.